Welcome back. Let's get into some market news now. The upbeat tone that has been characterizing the last week or so has helped Asian markets to fresh gains, particularly today. Now, with the Hong Kong on course for what is a sixth straight day of increases, investors globally have been riding a wave of optimism since last week when the head of the Federal Reserve indicated that it will likely slow its pace of interest rate hikes. Now, while there were also signs that China and the United States could eventually reach a trade deal, and there were gains which were not limited, of course, to equities. Oil was on the up about 20% from 17-month lows at the end of December, and high-yielding currencies were being supported particularly by a newfound demand for riskier assets. That includes South Africa's rand. But back in Asia, positivity flowing right through the market in the Far East. Tokyo's Nikkei up 1% to 20,359. The Hang Seng in Hong Kong moved up 0.4%. That's to 26,616, while the Shanghai Composite as well picking up 0.7% to close the week at 2,553 points. Over onto the United States now, and Wall Street extended its rally into a fifth straight session on Thursday with whipsaw trading as investors responded to mixed comments by U.S. Federal Reserve Chair Jerome Powell. And while a warning, of course, coming through from Macy's, that did pummel retail stocks. Now, the Dow Jones Industrial rose around 0.5% or so to 23,998 points. The S&P 500 0.4% to the good at close, rising to 2,596. And the Nasdaq Composite adding a similar mark to hit 6,986 points. Checking in on how the markets are doing across Europe as well as we continue to check in on that cycle, of course, leading up to the US Open as well a little bit later on today. But it does seem that things are fairly okay across the market spectrum. A little bit of positivity beginning to seep through. Perhaps it's some momentum that is beginning to gather steam. Of course, a whole lot of issues still need to be sorted. We continue to speak about that trade war. Brexit will be quite significant as well. That US shutdown, that is beginning to forge some impact. And Jerome Powell out in the United States, the Fed chair, what his decisions will be when it comes to raising interest rates or keeping them at their current levels will be quite key. But for now, let's check in on those European and local markets. A better mark for the rand is certainly going to be very important when it comes to our fuel price. So we'll unpack that and a whole lot of other issues as well. Viv Govender from Rand Swiss joins me now from our studio at the JSE. Viv, thank you so much for your time. But 0.8% to the good. It's generally seeming like a more positive fit to the end of trading, which is the first week of full trading for 2019.
Yes, so we are seeing some signs that the China-US trade war may be coming to an end. I think the Americans, which are driving the tensions here, President Trump in particular, has other fish to fry. We're about to hit the longest shutdown in U.S. history in the next couple of days, and there seems to be no sign of compromise on either side around that. And I think he might just want to take some stuff off the table, including this tension with China at this moment in time.
Yeah, and if he continues to do that, it's bound to bode really well for global economics and including global markets. If you take a look just behind you, Viv, I mean, the leaders there just seem to be the banks, some retailers there as well, and of course Naspers with Tencent having done so well. Where do you see the real growth for the remainder of the year? Where do you see the real opportunity, considering how bad 2018 was?
Well, I mean, locally, it's quite difficult. I mean, I still think offshore is where you want to go to. I mean, if you see that World Bank report that growth for 2019 in South Africa is going to be 1.3%, and this is a downgrade from 1.8% that we are seeing just 6 months ago or so from the same organization. And if you compare that to global rates, for instance, if you compare that to Africa, African countries are going to be growing at around about 3.2% or so for this year. The global growth rate is going to be 2.9%, and we are doing 1.3%. So even compared to the world as a whole, we're going to be growing at about less than a half of what the global growth rate is. And for emerging markets as an overall thing, not just African emerging markets, world emerging markets, we're looking at in excess of 4% growth rate. So I think if you're looking at where in the world you're probably going to see a recovery, it probably is going to be emerging markets with that kind of growth rate. But South Africa at the moment, companies that are linked primarily to South Africa, things like the banks and things like the retailers that are focused primarily in South Africa, are probably going to find it a very tough year again.
Yeah, I want to talk about that oil price, and just above you there and behind you, really. The oil price, just as it stands there, is a little incorrect. It's actually at around $61 or 62 odd dollars a barrel. Should we be concerned? It's now gone back above $60 a barrel. Are there concerns that, of course, the cut that was announced last year will filter into trading this year and affect markets a little bit more?
I think it will, most certainly. I mean, if you think about it, when the cuts were announced, we were around the 59 level. There was a brief period in December where we went as low as the very low 50s. You know, I think at one point in time we even broken the 50 level for Brent. I'm not sure about that, but I think we did. I was on holiday at the time, but I remember something like that happening. But we've recovered significantly since December till now. There's an excess of 20% recovery in the oil price since then. And I think we could be seeing another move of a similar magnitude going forward. I think that many of these countries rather are looking to raise prices because they haven't really done very well over the last few years, and they need a very high oil price relative to where the cost of oil is in order to balance their budgets. The one thing that was a saving grace at the end of 2018 was actually that murder of that Saudi Arabian journalist. It forced Saudi Arabia, which is the biggest movement in OPEC, to basically maintain the pipelines to make sure to basically calm down Donald Trump until the storm blew over. And so they kind of gave him a win for a few months, keeping oil prices at about $60 a barrel, just to basically take the heat off their own crown prince, who was very strongly involved in that murder. But I think now, the news cycle hardly ever talks about it, and if we can see that being removed from the limelight for a bit, we are likely to see the Saudis basically go into their proper focus on oil, and probably wanting to see oil prices in excess of $70 a barrel at the very least.
Yeah, the U.S. market is back to gains. The labor market seems to be quite strong as well. But one area in which he's going to lose out is if he gets into a recession, right? Do you see that fear really coming to fruition? Do you think that there will be a recession perhaps in the United States this year?
Look, I mean, they shouldn't be, maybe put this way. It's very easy to avoid the recession, either give them the $5.5 billion, which is, in American terms, $5.5 billion is like peanuts. It's stuff you'd find in the couch cushions, basically, for the American government. It's a tiny amount of money. Or he basically crumbles and we get some kind of deal done that gets the government up and running again. You do that and the US economy would likely grow again in 2019, maybe not as fast as the 4% plus we saw in some quarters last year, but probably a reasonably strong growth rate in excess of 2% easily. But if we do see this become a political bun fight where we see neither side willing to back down over this very tiny, like I said, monetary amount for the wall, we could very likely see knock-on effects in the economy. We've already started to see some negative effects coming through with regards to maybe some of the stuff that we saw with retail sales over Christmas being negatively impacted. Remember, there's about 1 million people almost that have not gotten the paychecks. And there's also going to be things like, for instance, developers who are not going to get approval for certain things because they have to wait for the relevant departments to come back online, etc. And if you see that running for maybe 3, 4, 5 months, you can easily see this being a sufficiently disruptive event to push the US market or the US economy into a recession.
Yeah, Viv, appreciate your time. But just with regards to that rand against the US dollar, now at around 13.83 or so against the greenback. Quite interesting, of course, that it does move, particularly from could be a worsening of around 13% or could be a strengthening of around 8% as well. So that'll be quite interesting, quite keen. I thought we'd very quickly as well touch on just very quickly these market pictures. Of course, the likes of MTN as well, doing fairly well of late, and we wanted to touch on just how those market figures are certainly faring. And if you take a look at the graph behind me, you'll certainly see the picture of how these companies have fared of late. MTN, Nigeria taking a toll, 35% lower, that is, for the price of oil. That's particularly since January last year. As you can see, this big fall around this area is when the Nigerian authorities came back to MTN and told them that they had repatriated funds illegally and unlawfully as well, and that share price then collapsing well towards 70 rand a share from the heights of around 100, 110 or so. So that figure's slowly trying to creep back up. Perhaps the fundamentals for this year are a little bit easier, considering that at the end of last year, we saw that announcement by the Nigerian authorities that 8.1 billion rand fine has now been dropped off to $53 million. However, that is still a big figure. And of course, they still have the tax fine of around $2 billion US dollars as well. So if they can get that out the way, perhaps things will get a little bit better. But they have gotten a warning as well from the ratings agencies that if they increase their stake in Nigeria, things could get worse for them, and they may get a downgrade with regards to how things fare on that front for the company. Another tech stock company I just thought was very significant. This seems to be primed for another uptick. It fell around 17.5% just last year alone. That is the price of Naspers. That tech tumble may indeed be reversing. As you can see, that lowest point there with regards to November in that region, still above 2,300 Rand a share, of course. But there are estimates by JP Morgan that this could rise around 44% in 2019, which would see the price rise very firmly above that 4,000 Rand mark to around 4,250 or so, which would then value the company at 1.8 trillion Rand. Let's remember that 1.8 trillion is very close to just how much the PIC, which is, of course, Africa's largest fund manager, is managing by funds alone. This company would certainly be the behemoth that it continues to grow into at present. Nearly 2 trillion Rand would be the value if it was to grow 44% this year alone. Maybe some value indeed for the share price of Naspers. Continue on to the retail space. Now, I found this very interesting to touch into. Pick n Pay itself has grown around 7.5%, just above 70 Rand a share. And the interesting element about this has been that it's outperformed all the other retailers. When their results came out, it seemed to be doing better than anybody else. And the reasons for that is because of their clothing and their food business, which seem to cater to the exact markets in which they've decided to go into, unlike the likes of Woolworths, which have struggled, of course, particularly with their clothing brands. Shoprite is seemingly struggling across the border as well with many of their African regions, but it does seem there's a steady sense of growth here for Pick n Pay. Is there perhaps another rebound expected on this counter? It's certainly going to be interesting for the year, and I thought it would be quite significant for the retail space to perhaps follow this module of just gradual gains for the year. But here's another one that perhaps will see a rebound headed into 2019, Capitec. Now, the banking sector itself has been really, really massive and quite significant. A lot of competition coming through. The likes of Time Bank, of course, the likes of Discovery as well coming into this area as well. Around 5.6% gained as well for Capitec. Is it primed for a rebound? Well, clearly, more than 5% gain, even though it did lose about 15% at some stage earlier on in 2018. But as you can see, a gradual recovery. So over the long term, which is what you should be investing in, a value investor goes long term. Let's remember that. Then you may want to stick with this one as it continues to gain somewhat over the long term there. 5.6% gain just in 2018 alone. That is a look at just some significant counters and markers that may be of keen interest as well. Headed into 2019, they perhaps set the stage for what the markets could do headed into the remainder of the year. Let's take a quick break. We'll be back right after this.